So current market factors and indicators, data points I'm currently taking a look at and focusing on in the back half of 2023 are credit spreads, earnings revisions, and finally employment. So when we take a look at credit spreads, if we think about fixed income markets, typically fixed income markets react a little bit sooner relative to equity markets. So take the yield curve, for example. It has been inverted for quite some time. Fixed income markets signaling that a potential recession is over the horizon. Again, that indicator does not tell you when the recession's coming. It typically just indicates that a recession's coming at some point in time. Historically, it's been anywhere between 6 to 12 months to 24 months after the inversion first happens. So again, when we think about credit spreads, typically you do see cracks in the credit market early on as we're going into a potential recession. Conceptually, this makes sense, folks, because credit spreads reflect the creditworthiness of corporations. So again, when we go into a recession, default risk, probability of default typically rises, and as a result, you see a widening in credit spreads. So year to date, we have not seen credit spreads widen. In fact, we have seen them tighten modestly. So keeping a close eye on those credit spreads to get some indication if a potential recession is coming. Next is earnings and earnings revisions. So at the time of the recording, we've got about 50% of S&P 500 companies that have already listed their earnings for Q2 of this year. About 83% of those companies have beaten. So on the face, it looks like a great number, but what people need to think about and appreciate is that we have been consistently getting downward revisions to earnings this year. So again, it'll be important to keep an eye on earnings in Q3 and Q4 for the rest of the year, but it's also going to be very important to keep an eye on those earning revisions to see if they continue to trend lower. So to give us a good insight into where equity markets may be heading in the back half of this year. And then finally, we've got the employment numbers. As we know, employment is a lagging indicator. There are leading indicators, concurrent indicators. Concurrent indicator being GDP, which again has ticked a little bit lower, but still in positive territory for Canada. Still looking decently robust in the United States. But I do want to keep an eye on those employment numbers as well. As we know, we do live in a consumption economy. So again, folks getting unemployed typically portends to less demand, which portends to lower GDP growth. So again, keeping a close eye on all three of those factors, the earnings revisions, the credit spreads, and the employment story on a go-forward basis to give us further insights to where markets are heading in the back half of 2023.